Will you have enough money when you stop working? It's a question that keeps millions of us up at night, no matter our age or background. Whether you're just starting your career or counting down the days to retirement, the uncertainty about your financial future can be overwhelming. For many, the dream is simple: to enjoy your later years without worrying about bills, healthcare, or running out of money. But how do you make that dream a reality? For decades, the answer has depended on the stock market. The ups and downs of global markets have shaped the fortunes of pension pots everywhere, making retirement planning feel like a roller coaster ride. Every dip and surge in the market can mean the difference between a comfortable retirement and a stressful one. But now, financial giants like Blackstone, managing over $1 trillion, are turning their attention to your pension pot. These are the same firms that have long influenced the world's wealthiest investors, and now they're eyeing the savings of everyday workers. Traditionally, Blackstone invested for the ultra-wealthy, offering exclusive deals and access to markets most people could only dream of. But now, they want to bring those exclusive opportunities to your workplace retirement plan, opening doors that were once firmly closed. This could mean your pension gets access to high-growth startups, companies at the cutting edge of technology, healthcare, and innovation. Imagine your retirement savings helping to fund the next big breakthrough and sharing in the rewards if those companies succeed. Or luxury real estate, investments once reserved for billionaires and major institutions. These assets can offer steady returns and diversification, potentially making your pension pot more resilient to market swings. It's a seismic shift, promising new opportunities but also raising big questions about risk and access. Will these new investments make your retirement more secure, or could they expose your savings to new dangers? And who decides which opportunities you get to participate in? Is this the key to a more secure retirement, or a high-stakes gamble with your future? For some, it could mean greater growth and peace of mind. For others, it might bring new worries about transparency, fairness, and risk. To find out, let's pull back the curtain on how retirement savings really work, and explore what this new era could mean for you and your pension pot. The 401k is America's go-to retirement plan, letting you invest part of your paycheck before taxes. Employers often match your contributions, free money for your future. Americans have over $9 trillion in these plans, mostly invested in mutual funds holding public stocks and bonds. This system is safe and transparent, but your returns are tied to the stock market's ups and downs. When markets crash, so can your savings. Blackstone and others argue that by sticking to public markets, savers miss out on bigger growth found elsewhere. They want to add something new, and potentially more powerful, to your retirement mix. Private markets are like an exclusive club. Deals happen behind closed doors, and until now, only the wealthy could join. Private equity means buying and transforming companies for profit. Private credit is lending directly to businesses. Private real estate involves massive property portfolios. These investments can offer huge rewards, but they're riskier and less transparent. For decades, only the ultra-wealthy and big pension funds could access them. Now, Blackstone wants to open this world to everyday savers. The goal? Let your retirement pot tap into early-stage companies and large-scale real estate, not just public stocks. But with new opportunities come new risks. Why is Blackstone, one of the world's largest investment firms, suddenly so interested in your retirement savings? It's a question that's making waves across the financial world, and it's not just about numbers on a page. It's about the future security of millions of Americans. The answer is simple, but the implications are huge. There are trillions of untapped dollars sitting in 401k accounts across the country. For decades, these retirement funds have been a sleeping giant, growing quietly, but largely untouched by Wall Street's biggest players. Even a small slice of that enormous pie could mean billions in new revenue for Blackstone, not to mention the hefty fees that come with managing these assets. For a firm that's used to dealing with the ultra-wealthy, this is a massive new opportunity. But Blackstone isn't just talking about profits. They're framing this move as a matter of fairness, an effort to level the playing field and give everyday Americans access to investment opportunities that, until now, have been reserved for the financial elite. Imagine being able to invest in the same kinds of private assets and alternative investments that have supercharged the wealth of the richest families and institutions. That's the promise Blackstone is making to regular people. To make this vision a reality, Blackstone has launched a new business unit dedicated to designing products that blend traditional public stocks with private assets, like real estate, private equity, and more, specifically for retirement plans. Their goal is ambitious: to become the go-to partner for 401k providers nationwide, reshaping how Americans invest for retirement. By offering a wider range of investment options and the potential for higher returns, Blackstone hopes to attract both plan sponsors and individual savers looking for more growth in their nest eggs. This marks a major shift for a company that has long focused on serving the ultra-rich. Now they're opening the doors to a much broader audience. Blackstone is betting that Americans, young and old, are hungry for new ways to grow their retirement savings, even if it means navigating more complex investment choices. Of course, with greater opportunity comes greater complexity. These new products may offer higher returns, but they also require savers to understand more sophisticated investment strategies and risks. If Blackstone succeeds, it could fundamentally reshape the retirement landscape for millions of Americans, changing not just how we save, but what's possible in our financial futures.
For years, strict laws kept private investments out of 401ks. Regulators prioritized safety, liquidity, and transparency. Private markets didn't fit the bill. They're riskier, harder to value, and tough to cash out. But in 2020, an executive order pushed the Department of Labor to reconsider. New guidance cracked the door open, letting plan managers add private equity, if they're careful. This shift gave Blackstone and others the green light to offer private market options in retirement plans. Now, private markets are no longer forbidden fruit. They're a new frontier for your pension. This regulatory change is the foundation for a multi-trillion-dollar business opportunity.
The big pitch. Private investments could mean much higher returns for your 401k. Private equity often outperforms public stocks by getting in early on fast-growing companies. Even a small allocation, 5% or 10%, could boost your retirement pot over decades. Private assets can also diversify your portfolio, making it more resilient when public markets stumble. Blackstone says everyone deserves a shot at these benefits, not just the wealthy. For savers worried about outliving their money, this new growth engine is compelling. But higher returns always come with trade-offs.
Higher returns from private markets come with real downsides, starting with risk. Unlike traditional investments in public stocks or bonds, private market opportunities are often less regulated and less transparent. This means you may not have access to the same level of information or oversight, making it harder to judge what you're really getting into. You're betting on unproven companies or complex deals. Losses can be total. Many private investments involve startups or businesses that haven't yet proven themselves in the market. If these ventures fail, investors can lose their entire investment with little recourse. The risk is real, and it's not just about market swings. It's about the possibility of complete loss. Fees are another issue. Private funds charge much more than low-cost index funds, eating into your gains. These fees can include management fees, performance fees, and even hidden costs that aren't always obvious at first glance. Over time, these charges can significantly reduce your returns, making it harder to achieve your financial goals. Plus, your money is often locked up for years. You can't just cash out when you want. Private investments typically require you to commit your funds for long periods, sometimes a decade or more. This lack of liquidity means you lose flexibility, and if you need your money in an emergency, it may not be available. Critics warn that savers may not fully understand these risks or the true cost. The complexity of private funds can make it difficult for everyday investors to grasp all the potential pitfalls, and disclosures are often dense or confusing. Without a clear understanding, people may take on more risk than they realize. While firms are trying to make private funds more accessible, the fundamental dangers remain. Even as new products are marketed to a wider audience, the underlying risks, lack of transparency, high fees, and illiquidity haven't changed. Investors need to be cautious and do their homework before diving in. The question, are the potential rewards worth the extra risk and cost? For some, the chance of higher returns is tempting, but it's important to weigh those possibilities against what you could lose. Every investor's situation is different, and what works for one person may not be right for another. It's a classic dilemma for anyone planning their financial future. Deciding whether to pursue private investments means balancing your appetite for risk, your need for flexibility, and your long-term goals. In the end, understanding the trade-offs is key to making the right choice for your own financial journey. Blackstone's push into retirement is led by top talent, Heather Von Zuben, Tom Nides, and Paul Quinlan. Von Zuben brings product expertise. Nides, a former ambassador and Wall Street exec, handles strategy and government relations. Quinlan, with deep real estate experience, manages U.S. operations. This high-profile team signals Blackstone's commitment to dominating the retirement market. They're not dabbling, they're betting big on transforming how Americans save. Their combined experience is meant to build trust and navigate complex regulations. Blackstone is all in on this new era for your pension. Blackstone isn't alone. Other giants like Apollo Global Management and Blue Owl Capital are racing to bring private markets to 401ks. Apollo offers hybrid funds mixing public and private assets, aiming for higher returns with some liquidity. Blue Owl specializes in private credit, partnering with retirement plan providers to reach more savers. This competition is driving innovation and could mean better products and lower fees for you. But it also adds complexity. Plan managers must sort through a growing menu of sophisticated options. The industry is shifting fast, and everyone wants a piece of the multi-trillion-dollar pie. For savers, more choice means more responsibility. So, what does this mean for you? It's a mix of exciting opportunities and new risks. Private markets could boost your retirement savings, but they demand more engagement and understanding. These aren't set-and-forget investments. They're complex, with higher fees and risks. Employers and plan managers must carefully vet these options to protect savers. The pressure is on to balance growth with safety. We're at the start of a major experiment in retirement saving, one that could reshape financial futures for millions. As this unfolds, stay informed, ask questions, and keep a close eye on your pension pot.